program that works for either your first time buying or your second time buying. So we're gonna go through all of that in a minute. So thank you all for coming. Let me put up the slide and we will get started. We always finish exactly at 11. So if you just endure us, 11 o'clock, we'll be done. Thank you so much. All right, let's share the slide. Oh, wait a minute, I need to download thing first. So it doesn't come. Okay. That's cool. All right. Jesus, I think I need to download it too. 1 second, I'm sorry. There you go. I want it to be a full screen. Thank you. Yay. Awesome. All right. Little technical challenges there. So today we're going to talk about how to finance real estate for first and second time buyers. I'm going to entertain a lot of questions on this one, and we're going to navigate ourselves through. I don't know if Chris Rivera is on the line yet.
Not yet, Gary.
Okay. I do have a lender that will be on, but I don't really want to have lenders because I'm going to share secrets of every program. It's really great that I've been blessed to do a lot of transactions. Thank you for all of our patrons for that. But more importantly, I've learned along the trade of what works well for people. And I'm constantly talking to different lending programs to find out what they do and how it can benefit my clients. So I'm going to share that because if you go to one lender, you go to Bank of America, you go to Chase, they're going to give you their program. And their program is based on their guideline. If you go to a broker, they're going to give you their program. And their program is based on what's available to them. So what you have today is the benefit of someone that's a student of the game. And I'm able to share all these different programs with you and different guidelines, different set of guidelines that goes with that. But let's get started, shall we? All right, Gary Nix here, team broker with Gary Nix team. Got a good team. We're doing very well, so thank you. It's not just the time in the business, it's how many exposure you have. And even though we are one or two people or three or four people, now we're like 5 people, it's really the amount of experiences you've had along the way. And good or bad, I've had a lot of them. Okay. Chris Rivera with actually it's with what's the name? Abo Financial now. So he will be joining us just to answer to help us navigate through. But we wanted to start today really in the dream world. Okay. If all things were right, we need to understand why the value of a home. Why the value of home? You know, uh, this land is. I don't know if you even go back to the Good Book. Okay, I know the Good Book is something we don't mention lately, but if you go back to the Good Book, it's all about land. The Israelite fighting for this. It's about land. It's what creates ownership. It's what creates entitlement, for us. And this great country was founded based on that. It was a set of people who seek a new land, right? And to get a new land, you have to conquer people in it to take over the land, right? So I think we forget about that. That so much life went into that process of getting the land. I always love watching movies about somebody. I think I watched a Tom Cruise movie coming in into the country, to find his land, with his girl. It's always a very beautiful thing. Okay. So owners, owning a land is a sign of wealth during the Spanish and English colonization. If you own your piece of land, it's like you are wealthy. And the truth is, uh, if you look at the top 1%, top 2%, top 10% of Americans, they were because they own land. And some of them just owning at a different level, at a higher level, right? But you can break into that by owning some pieces of land yourself. Okay. Now, I kind of want, because there's a lot of things to talk about mortgage rates, and I wanted to kind of give us a perspective for years that it's been. I'm sure there'll be some people here that bought homes. I'm just curious, anybody here bought homes over 10 years ago? Let me see. Okay, thank you.
I did.
Okay, thank you. So if you bought homes, this is kind of reflecting the times, right? If you bought homes, look, people that bought homes in 1982, they were buying it at 16.63 interest rate. And Chris is not here yet, but it sent out an email that I really love. It said, marry the house and date the mortgage. I thought that was very, profounding, because, if you married the house, you bought the house at 16.63, well, you got the house, whatever price you got it for. Well, we know, we're going to go back to another slide that shows the value of real estate, how it goes up, right? The house is going to go up and the rate is going to change. So you have it at 16.63. At one point, you got it at 9%, 8%, 4%. At one point, it went down to 3%, right? So it's getting the house and then the opportunity to refinance the house, which is a beautiful thing. You get a home, you live in there, and you lower your rent or you lower your mortgage, so to speak, right? Because you refinance the home. That's the thing we don't recognize. We always look at it at the time we're buying it. All right. So this kind of gives us a reflection from 82 to 2022. And we're pretty much right there. The rate has gone down a little bit now from 7.81 when it was 8%. Okay. And this is just to show a little more recent where the rates, at one point in 16, it was in 3.87 rate, and it went up to 6.9, came back down again. So it really doesn't matter at where you get it. You're gonna have opportunities with it. Okay. So I want to move forward to give us the value of real estate. Real estate is a leveraging investment. It's an able investment. Its value never goes to zero. If you buy stocks, it can go to zero, right? I don't know if anybody bought. I was watching the news the other day. President Trump, crypto dollar. Some people, before he became president, it was like 75 cents, and it's gone to $73 a share. So if you're into crypto, it can go up, but it can go down like that too, right? So that's what you have with all this other investment. But the bottom line is real estate will never go back to zero. It's always something someone will live in. It's accessible. Anyone can buy it. It's appreciable. It increases in value over time. It's rentable. So if you own a home, you can rent it out if you decide you don't want to live in there, right? You want to move to another neighborhood or whatnot. Improvable. You do some little work, you do an upgrade here and there, you start creating even more value for it. And then you can deduct it from your taxes. I mean, that's like the beautiful thing of owning real estate. It allows you to deduct your tax base without reducing your income base. Yes, a lot of people will make a lot of money and then they will write it all off because of this on business. And when you do that, your income value goes down, so your buying power is less, right? But real estate, you can do all the deductions and it doesn't lower your income value. That's another profound thing. It's very stable because it's slow to fall most of the time, and it definitely rise up. And of course, it's a place you can live in. So I want, if we have all this in our mind, then we know the value of home is incredible. So to also give you a little bit more sense, we're going to come down to the financing, but I just wanted to make sure we understand the value of doing this thing, right? I'm not going to go through all of this. If you are looking at the slide, you can see that in everything else, you got to come up with the money you need. You want to buy crypto, $100,000 crypto. Guess what? You got to put $100,000 into it. You want to buy $100,000 bond. Guess what? You got to put $100,000 into it. However, real estate, you want to buy 100,000. You don't need to put 100,000. You may need to put $3,000 into it. I've been blessed to have somebody buy real estate for 500,000, and all they put is $5,000 out of their pocket. And today, that 5,000 has grown to over $200,000 for them. So it's so much more than anything else you can do. I'm not discouraging you on doing all of this, by the way. I do some of those too. But the most valuable one is the home you can buy. Okay. So it's basically leverage using other monies, bank, mortgage companies, and whatever, to own an asset. Instead of you using all your own money, you can use other people's money to own an asset. There is nothing better than that. Does anybody? Oh, Chris, I see you now. Okay, cool. Thank you for coming on. Okay. Any comments on that? Chris, you want to join me on that? We got no audio.
Okay, good. Can you hear me?
Yeah, I can hear you.
Yeah, no, I think that's a powerful topic that you're talking about, and very few people talk about that, the power of leverage, because you're right on, Gary. I mean, if you want to buy stocks or bonds or any asset out there, you got to buy it all of its entirety, right? This is something where you just have to put a small percentage down, and the appreciation of the asset is 100% yours.
Yeah, awesome. Thank you.
It's just a powerful, powerful thing.
All right. And again, to give you how your money works for you or you work for your money, right? Everything else, you're working for the money, you put money into it, and you just keep working on it. But this one here, you put a little money into it, and that money starts growing for you. It's like living underneath a tree, and the tree start producing seeds, and seeds, right? You just plant the seed, and the thing is growing for you. That's kind of like the concept here. I think I have a little bit more here. So when you buy a home, you put some money into it, you have a lot of debt. Yeah, that's what people are like, I don't want to have debt. Okay, big deal. All right. But that debt start going down, and your equity start going up. The money you put in it is still what you put in it, right? You could put 40,000, 100,000. You can put 5,000, like a little earlier on, but your debt start going down and your equity start going up. And before you know it, you have a whole lot of equity, and the only money you put into it is what you put into it. Because eventually, if you're renting a place, you're going to continue to pay that rent forever. But you own a place, you're going to pay your mortgage, and then at one point, you're going to pay off the mortgage, and you have this much equity. And it's a blessing to get to that level. And if you own something for long, you'll get there, right? So why do people invest in real estate? A return on your investment, less out of pocket for more into pocket, tax write-off, grow your net worth through equity. I went to a luxury seminar, and they talk about the top 2% of Americans own like $2 million in equity or cash. So you live in California, you may own a home that's worth $2 million in no time. Imagine if you own two of those, you're worth $4 million when you paid it off. That's the beautiful thing about that. And it can be a college education savings. I'm actually, just to share, I met this man from China, and we were talking about how he's gonna get his son. They were moving from China over here, probably about 8-9 years ago. And I'm proud to say today, he did what I told him to do. I said, look, come here, buy some, he owned a condo in China that's worth $2 million, I guess if you convert it to dollars. And he had challenges bringing the money, over from there. But I said, listen, you go buy two houses here. By the time your boy, Johnny at that time was probably like around 11. I said, by the time he's ready for college, you're gonna pay his college for free. He said, really? Are you sure? I said, yeah, I promise you if you go do that. And he did. He bought two homes, I believe one in Diamond Bar, one in Chino Hills. And guess what? Johnny just started college in Austin, Texas now. And he sold one house, got $200,000 from it, right? And that's basically going to take care of Johnny for the next 4 years, right? And his goal is it will sell the other house when it can get 500,000. But that's how you build wealth. So he's going to take his son through college without costing him anything. If we all think like that, it's amazing, the result we can get. Okay. So when you're doing tax write-off, I wanted to really hone in on all this stuff, the benefits of home ownership and adding more homes and all that stuff. So we'll see that when we start talking about financing, it's not a big thing, whatever the rate is today. Oh, Chris, I was sharing your the email you sent out earlier on about marry the house, date the mortgage, date the rate. I love that email. So I kind of stole it from you and sharing it earlier on. Okay. So when you do tax write-off, you have operating expenses, you have mortgage interest. When you pay rent, the money just goes away. You could be paying rent $3,000 a month. At the end of the year, you've paid $36,000. It goes away. This one, you pay $3,000 a mortgage. You can write it all off, including all this other stuff, depreciation, capital, anything you do on the house, any stuff you buy into the house, all of that you can write it off, right, Chris?
Yeah, sorry, Gary. It's difficult to go back and forth from mute, unmute, but yes, absolutely what you're saying is so spot on. There's actually even more, and I know you'll get to it, but yes, that is absolutely correct.
Awesome. Okay, so we're gonna talk about the how now. So our goal is to educate you. I'm always interested in giving you a general principle of what's going on with different things, different ways to do things. And real estate is a very convoluted, industry. And it's always coming down to one-on-one as to where you are, what's possible for you, right? It's not as general as it is. But if you get this information, our hope is it will, it will energize you to take action And, we're here for you when you decide to do that. So let's talk about how to do it. Okay. So we're going to first talk about the first-time buyer program. What are the first-time buyer programs? Chris is on the line, so he can share with you guys on some of these programs. And some I will come into to talk about. Okay. All right. So you have to look at different lending programs that's available and how it's going to work for you. You being, your income, your finances, your credit, how much cash you have available, how much debt you have, all of that makes you. And then we will see which program that's going to work well. So I'll let Chris start with the first one.
Okay. Thanks, Gary. All right. So the very first one, which is
Is what?
Finance Authority. And that is something that is put on by the state. The beauty of this program is because it's backed by the state, it pretty much has unlimited funds. The program's been around for nearly 3+ decades, as long as I've been doing lending, and they've never run out of funds, and they're not about to. Because the state of California is really trying to promote homeownership for people who are looking to purchase. So what you need to find out is, first, how much do you qualify for yourself based on your income and debt load and credit score? And then with that, the state will give you the down payment and part of your closing cost as well, and help you become a first-time home buyer. Now, with CalHFA, though, it is a first-time home buyer program, so there are stipulations that you have to be a first-time home buyer. And they want to make sure that they are governing all of the transaction in terms of interest rate, the amount of debt to income ratio you can have, that sort of thing. And that's where I come in on the front end to kind of help you and guide you through that process. But the state itself is put this program forward for people to be able to buy. And it's available for any county in California. So the entire state of California. It is one of those things where it's just a beautiful program to allow people to obtain home ownership.
All right. Thank you. And by the way, this is the one that I think Chris actually helped me. Well, I still remember the lady, buying a condo, kind of a townhouse in Hawthorne. That was like $350, and all that came out of our pocket was $3,500. And literally, so here's the beautiful thing about doing this stuff. Like a year and a half later, right? I just called in to check in on her and say, hey, we've been a blessing to you. Who do you know that we can be a blessing to? And she's like, well, Mr. Nix, I kind of want a house. And like, really? And she put $3,500 like a year and a half before. And we decide, okay, she wants to go get a single family home. And when we sold the condo, she got like $115,000 out of it. Actually, she put $115,000 down. I forgot. I think she probably got like 130 out of it. That is incredible. Invest in $3,500, and literally a year and a half later, took $130,000 out. It is. I mean, that was really, really cool story. Thank you. So another one of those programs is what they call the Sensor Track financing program. I'm going to do a little bit more for you guys on this one. Let me stop the share. I want to show you what the Sensor Track financing program is like. So just give me a minute to navigate through going to the website, and I can share on the screen. Okay, Gary. Okay, thank you. All right. Oh, Jesus. Wendy, what is the website? It's just blank on my head. I should have put on the side.
Oh, I'm not
The one for the
fam-
Sensor Track. Can't believe this. All right, we are not gonna go there. We're gonna go back to what we're doing then. I'm sorry. I wanted to show you guys that so that you can see what the basically in the state of California, there are different. Excuse me 1 second. Let me go back on the screen. I know it blanked on me. I want to be more practical today. But, so there are different, all over the state, by the way. And by the way, it's all over the country. A census tract is there are different areas the state has marked as low to moderate income areas. Now, it doesn't mean, they are bad areas. It just means though that area, the people living in there, if you have an area where you have older people living in, and those people that bought the home, especially if they are baby boomers and stuff like that, they bought it a long time ago, and most of those people have stopped working. So they can look at the income in that area, and they encourage people to buy in those areas. And some of these areas, when we have to plug in the address, I wanted to show you guys, I don't know why I have a blank on my head. I wanted to show you guys how you go into it. So anywhere in the country, you'll find this property, and when you buy in those areas, there are just different programs available. You may have a down payment assistance where they give you more money towards the down payment. You may have where there's no mortgage insurance on the loan. It's just different programs that we can find for you. And I mean, I've had clients like, okay, find me one of those. And by the way, for those of you in the South Bay, there's an area of PV that's in the census tract. So living in PV, going to the best school literally in the world, and getting into it for as low as possible. So that's what that does. The other part of the program is called a community program. Community programs are programs, again, designed for first-time buyer, sometimes second-time buyer. They're usually lower than, their rate is usually lower. Actually, it was a time when their rate was higher, but you have other guideline that's better than standard Fannie Mae product. But currently, their rate are lower than market rate. And you can go as low as 3% down for a 640 purchase, or 5% down on up to 1.2 million purchase, and still have a lower payment with no mortgage insurance. It's really, really good. Then you have the LIPA financing, LIPA or LIPA, whatever you want to call it. Now they are running short of money now. Okay, I just got an email from them. You have to, but let me just explain what that does. That allows you to buy in the city of Los Angeles, and they give you up to $160,000 towards down payment. You have to buy in LA. It's very strict. It's a guideline based on income, and the number of people in the household. And you cannot, unlike the state one where you can just say I need people in the household for the income, this one, they're gonna verify by your taxes. They're gonna verify by everybody that lives in the house. They're pretty tough, but it helped people, and we've helped people through that process. Okay. Now, when people hear the city of LA, they think it's just LA. No, it's not. In the South Bay, that's going to be Harbor City, San Pedro, Wilmington, most of Los Angeles, all the way to all of San Fernando Valley is city of LA. It doesn't go beyond that. It doesn't go to Santa Clarita or Palmdale, but San Fernando Valley is, Woodland Hills, the city of LA, Beverly Hills, city of LA, it's under the city of LA. But of course, you're not going to find anything in this area that's going to work. So that's another one. And then people call and talk about the NACA program. The NACA program is actually very good, but it works for certain group of people. if you are in a high rental place already, you're paying $4,000 for rent, boom, NACA program, you can put zero down with NACA program. And you can use your money to buy down the rate as much as you want to. It's pretty much unlimited buying down that you can do with it. Okay.
Gary, someone's
uh,
raising his hand.
Who's that?
Someone is raising his
Vincent?
hand. It's
Okay, yeah,
Vincent.
Vincent, what's up? Vincent, you got a question? Okay, well, let me just finish this. So with this NACA program, again, it's if you're in a high rental, then it works. Most people go into it not understanding. They want to see whatever you're renting your place for. If you're renting a place for, you're in a 1-bedroom and you're paying $2,000, and now you want to buy a place that's 3 bedrooms, and your likelihood on that mortgage is 4,500. They want to see 6 months of your statement showing every month you save 2,500. The difference between the $2,000 you're paying in rent and the new proposed mortgage you want, or that your income qualifies you to be, because it's still going to be based on income and debt, right? So whatever your income qualifies you to be, are you saving that amount of money for the last 6 months? Now, what most people have been doing to kind of counter that is because people are, we are, including myself, we're not always consistent in our savings, right? So what people have been doing is they go buy an income property. So if you're paying $2,000 in a rent and your income property is going to be $8,000 in rent, $8,000 in mortgage, but you have 3 units there or 2 units there that's generating 6,000. Now you can get approved based on that. If you're into doing that. So again, it's navigating through these programs on how it's going to work, for you. All right, so we got some questions there. All right, okay. Let's move on. So that's a first-time buyer program. I kind of want to know, make sure if anybody has any question on the first-time buyer program, the different kind of loans. If you have question, we can maybe tailor that to the end. So if you want to buy, you own a home already, and you want to increase your wealth, because we just share with you how your wealth can increase by owning homes, right? And say, okay, how do I buy that second home? Let's talk about that. Okay. So of course, the typical thing you can do is save some money to buy a new home. Chris, come on in on this real quickly, that if how much you need to save for that second home?
So it depends on what type of property you're buying. So if you're buying a 1-unit place, which is single family, townhome, condo, that sort of thing, which we call a 1-unit, you can come in with as little as 10% down for a second home. Now, if it's units, then they're going to require 25% down, kind of similar to an investment. Now, it's not an investment property, it's a second home. There is a difference. So a second home means you're going to be in that property for 6 months out of the year. Or you also do not intend to actually rent it out. It's something that you're going to have as a second home. It could be in Palm Springs, Santa Barbara, maybe La Jolla, something like that, where it's a place that you want to go on vacation. It could even be in Miami. That could still be a second home. But you're not going to have any income derived. So when you qualify, we have no rental income from that property to help offset that mortgage and qualifications. But it's a great way for you to potentially buy your retirement home. And I have a lot of clients that are getting up in years and are looking to get into that area that they want to retire, like Palm Springs. So they buy a home earlier so that they can have a nest for them when they retire. But that's what a second home is.
Okay, thank you. Now, again, our goal is to share with you other ways to make that happen, right? So the other ways where you can buy that second home to make it easy, of course, especially if I love buying in California because to me, that's where you build the quickest wealth. I mean, I can tell you, I have a friend of mine that moved from San Francisco to Dallas, and they own a couple of homes in San Francisco. And they moved to Dallas, they bought a nice house there. And, he called me up like, Gary, we've been here for 2 years and our home is basically what it was. It's gone up like $10,000. Like we're not used to that. In California, our home, I remember they had a home in Pittsburgh that they bought for like 200, I don't know, 15, 20 years ago. That's worth like $1 million now. So it's like, whoa. So yeah, the beautiful thing is if you can buy that second home in California, I think it's great. I don't care whatever you buy in California, it's gonna grow. So if you're buying it close to you, then you have to be creative and say, hey, I'm gonna rent the one I'm living in and I'm moving into this one. And so that's when you get creative and making sure the new one you're buying is slightly different from what you have. Because the bank wants to know, like Chris said, if it feels like you buy a second home to own, you put 10% down, but you're gonna now get hit on income and debt, and your income is gotta be suffice enough to cover paying both mortgages. But if you don't have that income to cover both mortgages, you want to show you're gonna rent the one you're living in out, and you're gonna move into this new one, and you can still get away with it, a lower down payment, and so it's how creative you can be when we can guide you through that. All right. So other ways you can do it is you can buy a different property, but and put less money down. So what does that mean? If you're living in a 3-bedroom and you went to a 4-bedroom, the bank can see the sense in that your family has grown, you're moving to a bigger one. And guess what? You can also go the other way around. You can be living in a 3-bedroom and moving into a 2-bedroom and say, no, I want to downsize. I'm old. I don't want the big house anymore. And the bank can still buy that if it's within reason, right? So of course you can buy a property as an investor, so kind of like what Chris was alluding to. You buy as an investor, you put 25% down, you get the money, you can keep doing that for, I believe, up to 4 properties. How many properties can you buy again, Chris? With one, so long as you're putting the 25% down, how many properties can you buy?
Well, or allows you up to 10 now. So they changed the rules recently. It used to be 4, now it's up to 10. But I have investors that will allow you to have unlimited, as long as you qualify for it. A little bit harder, especially when someone has 15 properties to get their cash flow and to get them all their documentation. But really, it's unlimited in terms of rental properties.
Okay, that's good. So in this business, by the way, if you stop saying you know it all, you're always gonna learn something every day. And even I've had clients are like, oh, I bought a home before, I know everything. Like, okay, all right, things change, so much, so you have to adapt to the changes, that comes on. I used to have that mindset like, oh, you can't buy more than 4 properties. So it's like, okay, if I want to buy more than 4, I gotta buy and then have the wife buy something. So it's different, but that's cool to them. Okay. All right. So somebody sent me a question. If I'm getting married, what can people do to help me fund my real estate? If I want to buy real estate while I'm getting married, what do you have to say on that?
Okay, so it's called a gift. Is really the kind of the heading in which you can have someone gift you money for your down payment and closing costs. It's actually a really good idea. People can spend $10, $20, $30,000 on a wedding, and if they opt not to have the wedding and just have people fund their purchase, you can do a GoFundMe page, as simple as that. You can put it into an account and use those funds for your down payment and closing costs. but it's a great way for you to establish roots at an early age instead of spending all that money to get married. I mean, you're still going to get married, but you don't have to spend the 10, 20, $30,000 in doing so. But it is considered a gift, and it's acceptable on an owner-occupied property. 100% of the down payment and closing costs can be gifted to you.
Awesome. Thank you. You sent me something yesterday. I want to quickly share that so you can talk about that. Okay, so let's see. Okay, so because we're always trying to maximize what's possible. So this is, well, go ahead and talk about it.
Okay, so this is a $30,000 forgivable loan program. It's a down payment assistance program. You have to be a first-time home buyer, and you have to be buying in a certain area. But it's pretty much open in the South Bay. There's a lot of areas that use this program, and the way it works is give the buyer $1,000 for the down payment and closing costs. They can use it for whatever they see fit. And it is a forgivable loan program. So what happens is they place a $30,000 on the property. However, it is forgiven 20% per year. So after 5 years, it's 100% forgiven. So if you hold the property for 2 years and you got $30,000 from the lender, remember, every year you lose, or you are forgiven 20%. So you've forgiven 40%, which is $12,000. So you only have to pay them back the difference when you sell the property. But it's designed for people to be able to get into the housing market that have good incomes, which we have here in LA County. But it's so hard to get into the real estate market because the sale prices are so large. And the requirement of the down payment is really the stopgate for a lot of people because they can't come up with that down payment because it's so hard to save here, right? So these programs are designed for people to be able to get into the home as long as they qualify for the home. And this is a beautiful program because it allows you to have the $30,000 forgiven if you live in the property for 5 years.
Awesome. Thank you. All right. So I think we are done. Thank you so much for everybody here. Now, I want to leave time for questions. Anybody got questions on all of these, any of these?
I do. Hi, Jerry.
Hi, Dan.
Or Gary. Sorry. The main question I have is because I heard years ago that if you had bought a home and let's say you lost it for whatever reason and like 20, 30 years has passed, and over a certain period of time, that was my first time buy, let's say, and the first house, but then you haven't bought a house for 20, 30 years, that you could qualify as a first time buyer again. Is that correct? Is that still the way it is?
Actually, I've got better news for you than that. So first of all, we need to understand, and I try to let people know this, if we do that in our own daily living, America is great at second time around. It's great at forgiveness. And if we do that with people we know and don't say because they did something wrong yesterday, they don't have that chance. It's actually as low as 3 years. After 3 years of, it doesn't matter if you lost a home, if you sold a home, after 3 years, you qualify as a first-time buyer again. So thank you for asking that, but definitely, because a lot of people would think, oh, I lost my home, you know, can I buy another one? Yes, you can. 3 years later, you're back to being a brand new buyer. And you just got to let go. And, you know, when I get into investing in real estate myself, I remember I bought this nice house in Riverside County with a huge piece of land in there. And my goal at that time was to build 10 homes and I'm going to be a millionaire, right? And it didn't work out like that. And, you know, especially after my daughter's incident, blah, blah, I kind of slept on everything and I lost the home. I actually tried to do a short sale back then, but the bank don't know what the hell they're doing. But my point is that it does not mean that it shuts you off, because I know a bunch of people that did some investment in real estate and lost it, and they think that's the end of the world. And literally, I forced my way back into buying another property, and then buying another property and buying another property. So it doesn't matter what yesterday was, it matters where we are today, and pushing through. And it's really good that we have, I'm definitely around if anybody needs that guidance on, yeah, this is, you have a new opportunity today, and how can we navigate through getting that opportunity. Thank you. I'm actually going to share a program. Hopefully I can pull this one out for you all, that helps people in buying, in giving you an edge to buying into this world. Breach, let me see.
I just want to say while you're doing what you're doing there, the reason I asked is because knowing that every year something can change in real estate. So I was thinking, I wasn't sure where that stood now. That's why I was bringing it up. It's good to know that it's still pretty much the same.
All right. Anybody has a question?
Yeah.
Yes.
Oh,
Sure.
go ahead.
Yeah, Vincent, you can go first because you raised your hand before.
Oh, okay. Hi Gary. Hi everybody. I had a question about like, you know, is there any programs for the lower income people, say specifically the people on SSI or on a fixed income? Is there any like programs to assist them with any home buying?
Absolutely. I have been blessed enough to sell to someone that doesn't have literally a working income. And they have, you know, the SSI, and they had a pension. First of all, what you need to understand is if you have those kind of income, you are not taxable, right? So if you're not taxable, I'm always reminding my lender partners that, hey, you need to qualify them on 120% of their income. Because if they were being taxed, they will be making 120% more. That's number one thing. Number two thing is, again, we can mix it up with a down payment assistance program. It's just buying in the right place and finding that the gentleman that we sold, he bought a condo in LA, in San Fernando Valley, and he just had a retirement and SSI pro, you know, but we got him 100. At that time they were giving 90,000. Now they give 160,000. We got him $90,000 towards the down payment. So even though he was buying a condo that was like 300,000, with the 90,000, of course, there's no mortgage insurance, blah blah blah. He does have some down payment of his, so he add like 30,000 to that. So his mortgage that he was paying was like on 160 or something like that. It was very affordable, and it's still living there today. So it's finding what can help people to do that. Who's next? On the, okay, I see okay, let me see some questions. Wendy, can you just detect, you know, tell me, did somebody write any question down?
Yes, Pascal,
Mm-hmm.
if you have a home and still living there after 4 years, can you qualify for first-time home buyer?
Well, no, you don't qualify for first-time home buyer, but you do qualify for home purchase. But there are some programs that's good for both first-time and, oh, perfect question. Let me share the slide I wanted to share with you right now. This is what we have done. And Pascal, I think you took advantage of that the last time before, so you'll definitely know what it is. Okay. So this Bridge to Home Ownership program, this is good for both first and second-time buyer through this bank. You can pay as low as 3% down, no private mortgage insurance. The debt to income ratio is 55%. You know, it's just really, really good. And if Now your income, it maxed out about 192,000. If you buy more than $640,000 home, now it still works for you if you're gonna be living in the house. Okay, you have to show that you're gonna be moving into the house, but it can work for you to buy a duplex. We have a buy in escrow now. Prayerfully she'll close in the next week or so. That's moving from a condo to a duplex with this program, and it's really, really good. So yes, you can do that. It's just finding the right program that can work to make it happen. Anybody else have a question? Anybody else?
I do. I have another question.
Okay.
I have a question pertaining to, because I've known for years that HUD has houses that are foreclosed that they sell. How can you go about getting one of those homes? And there's something, it's called something else as well, but it's HUD that sells properties as well. How do you get that?
Well, there's not a whole lot of HUD listing now, but there are some, and they always give it to people that's gonna live in there first before investors can come. So it's just finding those listings, and whatever your income, and now most of those homes are they're not in great shape. So you do have to have a good. You can buy them with FHA. Maybe FHA 2 or 3K is possible. It'll have to be a rehab loan for most of those homes. But yeah, they just don't have a whole lot of them anymore because HUD is trying to not close on people. They're always making people to live in the house forever after they stop paying.
Okay. There's another one from Jean.
Okay.
Thank you, Gary, for asking that question about any program for people on low income, SSI, etc.
Okay. Oh, that's not a question, that's a statement. Thank you.
Oh, okay. How about this, Missy D? Hi, Gary. It's Missy. Remember, I talked to you about my son's issue. Oh, sorry. Okay, next one. Are the lending program funds being affected or diverted to the current fire victim, particularly in Cal FHA?
Well, being affected, meaning that if they're no longer available, no, it's still available. It's a different, I think FEMA is taking over the fire victims. Before President Biden, and I believe when President Trump came on, Trump is giving California a little bit of a hard time, I guess, because we didn't vote for him. But, but President Biden already, put an order in that all of them are gonna be covered. And that's going on. I see a hand lifted by Hannah.
Yeah, I was just gonna ask, how can maybe like multiple people in a family, maybe like 3 to 4 people, go about purchasing a property together?
Okay. Chris, can you answer that if you're still here?
Oh yeah, absolutely. So, the first thing I heard was that it's 3 or 4 people in a family, and I'm assuming that you guys currently live together. So absolutely, you guys could buy all together and buy a house owner occupied, because that's what you're doing now. As long as the bedroom and bath makeup of the home fits your current situation. So you can't try to buy a 2-bedroom, 1 bath and put in 3 families. That's not going to work. But as long as the property is big enough to house what your family size is, absolutely, you can bring around 3, 4, 5 people to qualify. Now, lenders do have, and this is more paperwork, they usually cap you at 6 people max, and it's just because the loan documents and all of the paperwork is designed for no more than 6. So if you get over that, that's when they stop you, just because the internal processing can't handle it. But to your question, absolutely, you can do that.
I have a question.
Okay.
I didn't get it was kind of drowned out, that $30,000 forgivable program that takes away $20,000 a year. Is that
No,
for
20
a first-time
20%.
buyer?
Yes.
Yes, $20,000 a year. Or
No,
20%.
Yeah, go
20%.
ahead, Chris, answer that.
Yeah, so it's 20% per year, which turns out to be $6,000 every year. So after 5 years, that gets up to 30,000. It's totally forgivable.
They loan you the 30,000?
That's correct.
And is there any specifications on there? Is it a first-time buyer or is it?
Yeah, it's first time buyer. They also they have income limits just like every other down payment assistance program out there. And those are usually set about 150,000 household income. But they also, if you're a first generational buyer, which is a different classification now, they'll let you go up to even 200,000 as a household income. So it's not just a first time home buyer program, it's also a first time generational program. And that's really huge because then it allows you to have more income to buy a bigger house. Um, but it's a great program because again, if you live in the property for 5 years, the entire 30,000 is forgiven.
Okay, thank you.
There's another question, Gary.
Okay.
It's from David Aruwolo. What is required for a first-time buying interested in buying a 3 or 4-plex?
Okay. Definitely. Basically, you put some money down. By the way, you can put as low as, FHA, right? Chris?
Yeah, so the thing is, most all first-time homebuyer programs are designed for owner-occupied, which is primary residence, and 1 unit. So you just asked for 3 and 4 units. It's very difficult to find programs like that. I do have a source that will allow for 3 and 4. You can couple that with an FHA loan. The problem is when you deal with 3 and 4 units for FHA, and I don't want to mislead you, the property itself has to qualify. So it's not just the borrower qualifying for that loan, the property itself has to qualify. And I'll go more in depth if whoever asked the question, if you want, personal one-on-one consultation, I can walk you through the 3 and 4 units for FHA. But there's one source that will allow it, but it's not your typical first-time homebuyer program. You have to understand a first-time homebuyer program, the ones that are out there are designed by state or county or city, whatever it happens to be. They're designed for first-time homebuyers to help them get into home ownership. And they're not looking for investors. And typically 3 and 4 units signifies to them that you're an investor. So they're not really trying to help investors buy property. They're trying to help first-time home buyers. And that's why it's usually only for 1 unit.
Okay.
I have a quick question pertaining to, he said generational buyer, first-time generational buyer. What's the difference between first-time generational buyer as opposed to just first-time buyer?
Right.
Okay.
So a first generational buyer.
Hold on,
is,
Chris. Hold on, Chris. I always want to keep my time. It's 11 o'clock. We're gonna answer one last question and we'll be done. So, Jean say, I want to buy a duplex with my daughter, but I'm on a fixed disability income, and I and my husband own a home which we are living in. I will be on disability for 8 months, and then I'll be returning from my job. Would I be able to purchase a duplex for her?
Okay, you want me to answer that?
Yeah.
Okay, so let me read the question. I want to buy a duplex with my daughter, but I'm on fixed disability income, and I and my husband own a home which we are living in. I will be disability for 8 months, and then I will be returning from the job. Would I be able to purchase a duplex? Possibly. It depends on what you're trying to do, right? So you're going to be a co-signer. So usually the first-time homebuyer programs don't allow for co-signers. I do have some programs that will allow for that, but I'm going to assume you just want to help your daughter buy it, just a normal transaction. Yes, you can do that. Your daughter is going to buy something as an owner-occupied for her single-family home, and you're not going to live with her, but you're going to co-sign. It's called the non-occupant co-signer. And we just look at your income and their income, put it all together. And as long as that total income is sufficient to qualify, then yes, you can do it. Now, in terms of you being on fixed disability, that's fine. If you're on permanent disability, we will use your disability income, whatever that happens to be. It could be from state, it could be from some other organization that you may have had insurance from. But as long as we know the likelihood of that disability continuing for 3 years out, we're fine with it. And again, long-term fixed disability will fit that bill, so we will be able to use it. In terms of how much, that's more of a consultation. You can reach out to Gary, and we can set up a meeting so we can actually go over your paperwork. But it sounds to me like you want to help your daughter out, and absolutely we can help you do that. And the fact that you guys own a home, you probably are sitting on a lot of equity, and I would assume that you may want to use some of that equity to help her with the down payment, and we can help you with that as well.
All right. Lastly, I just want to respond to this. We got Wendy, start preparing the Wheel of Fortune, please, so we can give the raffle out. How can you qualify for 800 single family home and a first-time buyer? That's absolutely available. I don't know who that person is. It says iPad. So just give me a call. We can set up that up. You can qualify for $1 million. It's always about your income and your debt. And we can go through that and see which program that's going to work the best for you. Thank you all so much for coming.